Okay, that's just a notification, don't worry. I'm just trying to record this class for people who have not made it. So I'm saying about divisional performance, I'm saying we divide the organization into respective divisions for easier management. Head office here wants to hold accountable the respective managers at the different branches here for whatever operations happen in the respective branches. So the reason why we have division performance is at the end of the day, we want to make sure that we're evaluating the performance of the respective divisions. Division A, Division B, and Division C. They could be more than 3 divisions, but basically the principle is the same. So we have different advantages that come with us having divisions. Of course, the decision making being easier, one of them, because these managers are on the ground, and so they are in better capacity to actually make the decision. So instead of having, let's say, a single maybe HR person, maybe in Uganda, they'll have now a divisional HR for, let's say, maybe South Sudan, maybe for Kenya, and maybe for Rwanda. So it gives easier decision making because these people are on the ground, so they understand whatever is actually happening on the ground. And of course, the other aspect is also the motivation. Once authority is given to staff down, then there is better motivation of staff. Staff are usually happy when they know that they actually have the responsibility. Are we together? I hope you can hear me very well. I'm trying to correct my audio here. Yeah. Okay. So we have the idea of easier decision making that we also have there, and then of course one of the other things that you can think about when you're running division is the aspect of okay, this could be at a higher level, but tax management and planning. By tax management and planning, I mean you're able to, for example, if it was MTN, I usually use maybe MTN South Africa. If MTN South Africa gives maybe MTN Uganda, and maybe you have MTN Zambia, and maybe you have MTN Congo. If these are respective divisions, meaning they manage their profits, they also manage, when it comes to, they manage both their expenses and revenue. These are actually become independent divisions that will comply within the tax management of the respective countries that they exist in. So it's very important for us to understand that. Basically, I just want to reference to what we need to basically know when it comes to our course outline, when it comes to division performance, so that can guide our discussion today. So division performance, basically, we need to understand things to do with functional organization structures and then divisional organization structures, aspect of profit centers and investment centers, merits and demerits of decentralization, prerequisites for successful decentralization. Basically here, what they are trying to mean, what are some of those key things that should be in place for us to have an effective Okay, just a moment. Okay. So I was saying that when it comes to the division performance, we are basically looking at companies that have branches, but also those companies that are doing things to do with subsidiaries. Basically, the reason why we do divisional performance measurement is because their respective managers. We have managers for each of the divisions or for the branches. Please mute, Andrew. I get an echo on your side. Help me mute. I'm muting you, Andrew, because I get an echo here. Okay. So I was saying that we have managers, and then we also, of course, we also have divisions. So basically, we want to evaluate managers, but also we want to evaluate the divisions. We want to see how our managers working as well as how the divisions are operating. And within here, we are going to get terms like controllable profits. And basically, controllable profits, these relate so much to managers, where we only consider only those kind of revenues as well as expenditures, as well as expenditures that managers have control over. That's where the aspect of controllable profit comes in. You get it. So that is very important for us. So basically, of course, we have just as we have benefits of having divisions, as earlier indicated. Of course, we also have cases of where we have challenges that might come with these divisions, as we will come to see. And one of the challenges usually rolls around the aspect of goal congruency. By goal congruence, we mean there's a tendency of divisions getting off the overall goal of the organization. So for an organization to achieve, of course, goal congruency, there are certain kind of mechanisms that have to be in place. And those are some of those things that we shall be looking at even as we proceed. But one of the challenges we have is the lack of goal congruency when it comes to some companies that are operating as divisions, where you get, I'll give you an example. You can find that maybe there are also terms like return on investment that we shall be using. We have return on investment and then residue income. You can find that maybe the overall return on investment policy for the company is 20%, but you find a division that wants to operate at less than 19%, maybe because of certain factors that may be affecting that. So we are going to see some of that. And then, of course, one of the other challenges that you may also need to know is the aspect of lack of economies of scale. The lack of economies of scale. By this, I mean, we know very well that if organizations are operating as a single entity, it means that they will have, let's say, a single, we can use different areas of economies of scale. It could be even staffing. Giving you an example of staffing. You may not need only maybe a single accountant to support on the respective divisions, but once you now divide your company into respective divisions, it means that you, at one point in time, need to have a division accountant for each of your respective divisions. So once you break down into divisions, yes, we are saying it's good, but it can also affect the aspect of you being able to benefit from the economies of scale, just in case you had your company as a single entity rather than divided into respective divisions or branches or subsidiaries. So that is one of that. So from the goal congruency, we have the lack of economies of scale. The other that you may need about is, of course, the loss of central control. By loss of central control, I mean once you have different divisions, it means that part of the control has to be given to the respective divisional managers. So as you who is basically having the overall control of the business, there is some kind aspect of control that you lose. And of course, this goes into you have to develop trust for the division managers to make sure that they are running very well. So those are some of the challenges that you might really get along the way. Now, we have what we call the conditions for successful decentralization. Now, of course, decentralization, this could also be divisionalization, but what we mean by decentralization, of course, it's dividing the organization into divisions and also giving powers to the respective managers of the different divisions. Very important. So we have conditions, and the respective conditions we have, of course, they should be a carefully designed performance evaluation system. There should be a performance system in place. And by reason why we should have a performance system in place is because at the end of the day, we want to evaluate how each division is operating. If you have division A, division B, division C, you want to understand how is division A operating, how is division B operating, how division C is operating, as well as the respective managers. And once you have, of course, the right system that is evaluating performance, it would mean that even you can easily know which division is operating either below or above the expectations of the whole entity. So there should basically be a clear performance system for us to achieve successful decentralization. One of the other that, of course, you should also have is that, of course, the business should have different activities. So every division should have clear activities, clear stipulated activities. So we should know who does what, so that we don't have cases of where we have conflict of conflict between the respective visions. So that is very important. Just a moment. I left my phone here a bit active. Just need to switch it off. Somebody is disturbing me right now. Okay. Thank you. So basically, the aspect of clear stipulation of activities. The other that you also need to look at is the aspect of policies. There should be policies to enable control, to enable overall control of the head office or of the overall organization. And by this, we mean since you're going to give respective authority to the divisional managers, there should be key policies that guide them. Maybe just as you have respective divisions, you can go ahead to actually have a single HR manual that works across the divisions, maybe a finance manual that works across the divisions, so that there is that kind of uniformity for anyone who is interested into maybe using the HR manual or finance manual. There's that kind of uniformity, and that's why you see for some organizations, once you go to branch A, you will definitely find very similar things that you find in branch B. It could be like banks. You could have maybe your customer service policy, how you handle customers. So that if one customer goes to branch A and fails to get the service, they can go to branch B and they are served in the right purpose. So that is also very key. And then, of course, the other that we also need to understand with divisions is the idea of independency. These divisions have to be independent from each other. They shouldn't have kind of course, cases of where there's a mix up of let's say resources, and also even at evaluation where you have challenges of separating division A maybe from division B. And this kind of independence will also facilitate things like maybe internal selling. By internal selling, I mean you can find, for example, if we have, if this was Coca-Cola that we are looking at as our example, and we have maybe a bottling department, and then we have maybe the selling department. Selling department, maybe, yes. Maybe we have also the juice department. So by being independent, we mean that it's very clear where we have internal sales that maybe the bottling department can sell to the juice department, maybe sell the bottles to the juice department. Like everything should be a bit clear that we can easily see an element of independence. And also we see that okay, in some divisions you can see that they can even be sales between maybe an internal department to totally an external, maybe an external organization. So that is very important. So performance systems have to be in place, clearly stipulated activities have to be in place, policies, and these are usually policies of that are set by the head office should be in place, and of course the aspect of independency. Very, very key for us to understand. Now, something else that I wanted to share with you before we can look at the question. Of course, we have different performance measures. Just as we've said that we should have a key performance system, we have key different performance measures. Now, some of these are quantitative and some of these are qualitative. So we have performance measures. Okay, so we have the quantitative. These are sometimes called the financial measures, definitely. And then we have the qualitative. Now, when it comes to the qualitative, basically, here we are looking at the division. How can we evaluate if a division is working well compared to the other? So we have what we call, and these are the common, these two are the common. We have the return on investment, which is also referred to ROI. And then we have the residual income, which is the ROI. Now we have also other ratios, other financial ratios, like maybe liquidity ratio. We can also have things like gearing ratio. Gearing ratio. You can have things like maybe payable days or debtors days, things like maybe inventory turnover, different of them. Because at the end of the day, given how your organization is operating, that would also dictate onto what exactly is the respective different measures that you're going to take as an organization. So very important that we are going to look at this. Now, of course, the qualitative ones that you could think about, This could be maybe around customer satisfaction, maybe which branch has a high customer rating. You could have things like staff turnover, in terms of maybe which branch has been able to hold more staff than the other. We could have qualitative factors around teamwork, maybe the level of teamwork. Of course, how you evaluate this requires different parameters that you may need to use in evaluating performance in such areas. Like customer satisfaction, this could be like a customer survey. Staff turnover, this could this comes in very clearly in terms of how many staff did you start with and how many staff have you been able to end with. So we are going to see how these apply even as we try out respective calculation. But before that, I would want to hint something small about the controllable profit and then divisional profits, because they are very key when it comes to this topic. Some of the other things I think I'll just give you reading materials that you can use to read. They're really understandable, so you shouldn't really worry. So we have what we call we have the controllable profit. I already talked of this one. Controllable profits. The controllable profits are usually used to evaluate managers. And when it comes to controllable profit, basically what happens is we are looking at, of course, if this is a division, maybe division A, we look at sales, and this could be external and external, but could also be internal. So that is for sales. And then we can have, of course, we can have your total sales, which are summing up here. And then you can have your, of course, less variable costs. Okay. And then you can have your contribution. Sales minus variable cost gives you contribution. This is less. Okay. And now after the contribution, you have the controllable fixed costs. The controllable fixed costs. Now, I hope you understand that when it comes to fixed costs, especially for divisions, you may find that there are also some costs that are charged by the head office. But for this case, the division itself may not have control over them. You get it, eh? Not only the division, but the manager. In this case, we are looking at controllable profit. The manager may not have control over them. I guess an example could be maybe the allocation of the CEO's salary onto the division. This is not within the control of the division manager. The division manager cannot say whether we are charging high or we are charging low, because it will just be a clear percentage. Management will just dictate and say, maybe we are charging 20% on all the divisions. If maybe these divisions are 5, maybe they will say each division is charged 20%. You get it? So it's very key for us to understand. Of course, after you've less the controllable fixed costs, this should be able to give you your controllable profits. Your controllable profits. Of course, this, yeah, basically is this could also be a loss. You never know, depending on how everything has really gone. And then now once you add, this is a controllable profit, but once you add other divisional costs, that are outside manager's control, the divisional costs that are outside manager's control. The reason why we are adding the divisional costs outside manager's control is we want to get what we call traceable profits. Now, when somebody says traceable profits, these are used to evaluate divisions. You know, when you're doing a divisional performance evaluation, you should be able to distinguish between evaluating divisions, but also evaluating managers. So when you're evaluating divisions, we use what we call the traceable profit. So if we have a controllable profit and we less divisional costs that are outside the manager's control, then we are able to get our traceable profits. These traceable profits are those that can easily be traced to that given division. I hope you're following. Now, in case we want to get the divisional profits, that thing is making noise, eh? That the noise of the campaign is making noise, so you stop your division. Okay, apologies. So I was saying that from the traceable profits, in case we want to get the divisional profits, then we can bring in the head office allocated costs. The head office allocated costs to reduce our traceable profits, then that gives us our divisional profits. Now, for you to understand, controllable profits, these are just to evaluate the manager. In case we want to evaluate the division, we go ahead to again less the divisional costs that outside manager's control. Now, in this case, we are now moving to what we refer to as traceable profits, as you can see. From the traceable profits, once we reduce the head office allocated costs, we now get our divisional profits. I've not been able to write it because my board here seems to be small, but you should be able to get the concept. So the divisional, once you see somebody saying maybe the divisional profit is maybe 20 million, it means that profit, they have already included, let's say, any costs that manager has control in, also costs that the manager doesn't have control on, but also they have also gone ahead to include the head office allocated costs. Now, why different companies have this aspect of head office allocated costs is in most cases, these head offices, they don't generate revenue. So at the end of the day, when they have costs, these costs have to be basically met by the respective divisions. So it's very important for us to understand this aspect of controllable profit and traceable profit. So controllable profits evaluate managers, while traceable profits evaluate the divisions. Very important for us to understand that. Now, very similar to this, since we have said that controllable profits is the one that we use to evaluate managers and then traceable for divisions, if you look at return on investment. Now, return on investment, I say this is one of those different evaluation measures that we make on two different divisions. Now, Return on investment, basically, we are looking at the general formula is looking at the profit. This could be your net profits divided by capital employed times 100%. From the word return on investment, basically we are trying to see how much was invested. This is what was invested. What is the return? This is the return. So the return as a percentage of the capital employed. You get it? It's very important for you to understand. And of course, capital employed, this is like your equity. Your total assets minus total liabilities. And then the net profit. Now, if we are looking at the manager, this ROI will be, the manager ROI will be, of course, controllable profits, will be controllable profits divided by the capital employed. So in case we are getting ROI to evaluate managers, that is how we would calculate it. In case we are getting ROI to evaluate the division, the division ROI, for it, it will be traceable profits out of capital, traceable profits out of capital employed. Of course, times 100 on all of them. ROI is usually represented in terms of as a percentage. So you can see the manager ROI, controllable profits over that, and then the division, traceable profits over that. So they can ask you the definition of controllable profits. Of course, those are the profits that are calculated as a result of taking into consideration the revenue, total revenue that is controlled by the manager, less the total costs that can be controlled by the manager. So anything outside that, anything that the manager doesn't have control over, it's not included. So I hope you get that. Now, the other that I also want to talk about, maybe we can see that in the example that we are going to basically do. Okay, you're going to get more. I said you get this paper of November 2018. So paper 11, November 2018. I'm going to just show it on the screen. Okay, it says Sweetbread Bakery Limited. Sweetbread Bakery Limited is a manufacturing plant with 3 divisions, A, B, and C. A shared service provider, SC, in Luzira division. Okay, and a shared service center, SC, in Luzira division. They're saying that division A is in charge of procuring materials, division B for baking confectionaries, and division C for distribution of finished products. They are telling us that all divisions are treated as investment centers and headed by managers. Okay, They are headed by managers. They are saying that divisional performance is measured on a monthly basis, and with effect from November 2018, senior management decided to start charging SCC costs to A, B, and C in the ratio of 1 to 1 to 2 respectively. So they go to say that SPBL has been measuring divisional performance using return on investment based on controllable profits only, which senior management has resolved to change with immediate effect. Full stop. SBL's target ROI of 20%. Now we say that before even I can go ahead, when they say division performance is measured a monthly basis, they also went ahead to say that management decided to charge SC costs to A, B, and C in the ratio. Now these are the allocated head office costs. Now when you're calculating your either controllable profits or calculating the traceable profits, you wouldn't include the these costs. But if you're calculating divisional performance for let's say for the month, then these costs have to be part of that. So they are basically allocated from the head office. So they are saying it has been measuring divisional performance, divisional managers' performance. So when they say divisional managers' performance, it means that we should only consider controllable profits. And controllable profits basically the revenue you've made, less variable costs, less the controllable fixed costs that you have in place. So, and then you're saying which senior management has resolved to change with immediate effect. So they have only been basing on controllable profits. They now want to move. And as we continue, we see that SBBL target ROI of 20% per month will remain unchanged. Divisions A, B, and C maintain their monthly ROI at 22%, 23%, and 21.5% respectively for the last quarter, and the managers have been enjoying healthy bonuses. Now, for you to note, the reason why these managers have been getting bonuses, definitely because the SBBL's target is at 20%, and these respective divisions have been getting a high ROI. So definitely they would be entitled to a return on investment, respectively. We move down. They're saying that all divisional managers are unhappy with the changes in performance measurement and have suggested that senior management adopts residual income, which may balance the interest of all parties. They propose monthly ROI target of shillings 12 million. SBBL's cost of capital is at 10%. So the other way of calculating performance is the residual income that we just looked at as well. Basically, this looks at the net profit and lesses the cost of capital. We are going to see how this works when we try out this question. So they are saying that they propose a monthly target of 12 million. SBL's cost of capital is 10%. So you understand that this 10% will actually be once we calculate, will be subtracted from the profit that we would have had. ROI is usually the residual income usually in terms of value, not like percentage, like the way we've seen for return on investment. So they are telling us that due to the coming festive season, the divisions have prepared their budgets operating statement for the month of December 2018 as shown below. So we have respective divisions, Division A, Division B, and Division C. We have sales revenue, 315. We have 320, and then we have 365. Then we also have controllable profits, 79, 800, as you can see. The reason why they have called them controllable fixed costs is because we are going to, they use currently the return on investment, and they based on controllable profits. So these controllable fixed costs, these are the ones we should use where we want to get, for example, controllable profits. So when we have the divisional net assets as per that, then we move down. The variable costs consist of 53%, 58%, 54% of sales revenue, A and B respectively. Now you can see this information, they basically did give us variable costs, but they have gone ahead to give us in terms of percentage. Definitely, we will have to calculate the variable costs. For example, for A, the 53% of the revenue will be able to give us our variable costs, the revenue, which is 315. As we proceed down, they are saying that SC's costs for December 2018 are estimated to be shillings 185 million. Then they say Division A has been buying finished wheat flour and selling it to Division B. However, management is evaluating the proposal by Division A's manager of acquiring machinery that can process and package wheat flour for sale to Division B and also to external customers. The cost of machinery is estimated at 160 million with a useful life of 5 years, after which it could be sold for 10 million. Okay, now here they have given you, they are saying SBL depreciates all its assets on a straight line basis. Basically, they have also given you the information that you need to calculate your depreciation. Definitely, if they have given you cost, useful life, as well as the scrap value, then you should be able to calculate the depreciation. Okay. And then you're saying the machinery is expected to increase the efficiency of the division, resulting into a 20% increase in the monthly contribution. Proposed dealings of Division A with Division B and external customers after acquiring the new machinery. So this is what is going to happen after acquiring the new machinery. One, they are saying Division A plans to sell packed wheat flour to Division B at an agreed transfer price that would then benefit SBBL as a whole. I already say that transfer pricing is a sister topic to this one. And basically why we have a transfer price is because we want to create the internal selling, an effective internal selling, where a division can sell to another division. So that's what the transfer price here means. So they're saying it will benefit SPBL as a whole. They're telling us the machine has a production capacity of 22,000 cartons per month. Division B has ordered 12,000 cartons of wheat flour for the month of December 2018. Well, external customers are expected to order 10,000 cartons. This is after the machine has been set up. A carton of wheat flour contains 12 packets of 2 kilograms each. The market price of a carton is shillings 50,000. Division A will transfer wheat flour to Division B at a marginal cost of cost plus 25%. So as we transfer these 12,000 cartons, they will be transferred at a 25% markup. And of course, this is your transfer price. The 25% markup. The additional, when you add this on the cost, it should be able to give you your transfer price. So they are saying the production cost per kilogram of wheat flour is budgeted at 1,600, 75% of which is variable. We proceed. They're saying that Division B and Division C always have damages and customer returns, what is commonly known as stale bread, which is highly demanded by livestock farmers. Division A has contracts with farmers to supply the stale bread at how much? 1,500, and incurs an additional 1,090 per month in selling and distribution costs. Both divisions B and C agree to sell SB to division A at how much? 800 kgs and also at 1,000 respectively. An average to 800 kgs and 3,000 kgs of SB are collected monthly by division B and division C. So we can see that division A has two products. It has the wheat flour that sells to division B, but also has stale bread that it buys from division A, division B, and division C, and also sells. So our question here was saying that evaluate the effect of the proposed change by senior management on divisional performance. So I'm going to stop share and then we can try this out together. So you need to get used on how to conceptualize case studies like those. Apart from the fact that I was reading, it's also advisable that you can go ahead to note some of the information that has been given. You can do the first reading and then maybe come back and now create, make sure that you make respective notes. So I want to look at the question here. So I can use it here. So they have told us that A, B, and C. Okay, SBBL. So this is SBBL. So they are telling us that they have division A, they have division B, they have C, and then they have, of course, the shared service center, which they are calling SC. Like that. And then they are telling us that division performance is on a monthly basis and with effect from November 2018. Management will be charging SC costs to A, B, and C at how much? At at a ratio of 1 to 1 to 2. This is ratio for SC costs. Okay. And then they are telling us that SBBL has been measuring divisional managers' performance using return on investment based on controllable profit. So they have given us the overall, the target of 20%. So the target is 20%, but what we have currently for respective, we have the current ROI, we have 22%. Then we have 23%, and then we have the 21, I think 21.5. Okay. They are saying that all divisional managers are happy with that current performance measurement, and I've suggested senior management to adopt the residual income. So this is the point that is prompting the question that we have here, which is saying that evaluate the effect of the proposed change by senior management on division manager's performance for the month. So they are proposing the ARA, the residual income model. So we have to go ahead to calculate how the residual income would look like for the respective divisions. Now, we've been given some information about the sales, about the controllable fixed costs as well, and they've also given us information about the variable costs as percentages. So what we shall do what we call a profit statement, but this will be for all divisions. So basically, we have divisions A, B, and C. So we have division A, B, C, then I'll call this total. This can be detail. Just to arrange my profit statement there. So I'll look at sales. The reason why I've taken this approach is because they want us to evaluate and see if we are using the residual income. I said residual income, how we calculate it is we do RI looks at the net profit minus the cost of capital. So basically we are trying to look at, you've made a profit, but how much was your cost of capital? So the difference, cost of capital can also be called interest. So after you've removed the payment to the people that gave you the capital, how do you remain with? And that's what we are referring to as our residual income. So our sales revenue for the respective branches, they are given in 1,000. So I'll try to include a degree of precision for each of the divisions. So these will be amounts, but with a degree of precision of 1,000. So we have 315. We have 315,000. We also have 320,000. We also have 365. Then we have, when you add the two, these respective totals, let me try to get my calculator. $315 plus 320 plus 365. This gives you 1 million, of course, which will be 1 billion in case you include the 3 zeros. Now they have gone ahead to give us the variable costs, just right there. They're saying variable costs consist of 53%, 58, and 54. So if remember, we are trying to calculate the performance using residual income. So we have to go through sales less variable costs. We get the contribution and then less the controllable fixed costs for us to be able to get the profit that we shall use here. So if I do 50 This is 53%, 0.53 times 315. This gives me, so we are less in variable costs. 166,950. Okay. Then we have for B, it's 58. 0.58 times 320. This gives us 185,600. You can also try out on your side so that in case I make any mistake, then you can correct me. Then for division C, 0.54 times 365 gives me 197,100. Now, I usually put the total column there because we also want to evaluate ourselves on the overall as an organization. So if I'm to do the summation of respective these ones, you should be able to get the overall variable cost. 16950 plus 185,600 plus 197, I think 100. This should be able to give you 549650. $5,496.50. So that's what we have. Now, after the variable costs, definitely you can go ahead to get the contribution. You can go ahead to get the respective contribution. This is that. So 315,000 minus 166,950. This gives you 148,050. 320 minus 185. This gives you 13. That 365 minus 197,100. This gives you 169,900. And then lastly, when you do 1 million and less 549650, should be able to get 450,350. So the contribution is all positive. Now we move to less controllable fixed costs. The controllable fixed costs, we have 79,800. We have 52,500. Then we have 46 46,900. You can also add those up and get the respective total on the other side. Now, you can add it. This gives you 17,9,200. This is a negative. These are all negatives since they are reduce our contribution. So from there, we should be able to get our controllable profit. You get the controllable profits. These are the profits that are within the control of the manager, and that means those are the profits that we should use to evaluate the manager. So in this case, 148,050 minus 79,800. This gives you 68,250. 1,344,100 minus 52. 500 gives you 81,900. 167,900 minus 46,900. This should give you 121,000. If it's 450, 350 minus 179, think 200. This would give you 27,1150. So those are our controllable profit. Remember, we said that if we want to go ahead to look more into how the division has performed, we now add other costs, divisional costs that are not within the control of the managers, and then we are able to get our traceable profits. But in this case, we don't have those costs that are for the division, but not under the control of the manager. Basically, what we have are allocated head office costs. The allocated head office costs. The allocated head office costs. So when you look at the question, they have given us respective percentages of what will be, they're telling us that they're going to start charging in the ratio of 1 to 1 to 2. So your question should be, what are the head office costs? Now, when you move down, on, there's a statement there after variable cost that says the SC costs for December 2018 are estimated to be 185 million. So if we are sharing into the ratio, this is 185 million that we are going to share in the ratio of 1 to 1 to 2. It means that A will have 1 over 4 times 185 million. B will also have the same thing, 1 over 4 times 185. C will have 2 out of 4 times 185. So let's just try to calculate this. 0.25 times 185 gives you the 185. I hope you can see it, just a statement down there, but it should be able to give you about 46. Okay, I can use 1,000 here since I'm using 1,000. So the allocated cost here will be 46,250. So since even B has the same ratio of 1, we also put 46,250. And then for C, they say that theirs is 2 because it's a ratio of 1 to 1 to 2. So it's basically when you do 2 over 4 times that, it's basically a half of 185. And a half of 185, 0.5 of 185 gives you 9,500. 9,500. When you add this up, you should be able to get the 185 million. 185,000 right there. Are we together? So ratio of 1 to 2. So since we don't have any other costs, we'll go ahead to get our net profit. Why we are getting the net profit is because we want to calculate the residual income that is based on net profit less the cost of capital. I want to put this in bracket as well since these are costs. So we shall have 68,250 less 46,250 gives you 22,000. Then we have 81,900 less 46,250. I think it gives you 35,650. Then we have 121 less 92,500 gives you 28,500. When you do 27, 150 less 185 gives you 86,150. As you can see that the 86,150. Now we've gotten our net profit, and now the next question should be, what is our cost of capital? Now, cost of capital, they have given us in the question that the SBBL's cost of capital is at 10%. Now, this cost of capital is definitely on the net assets. Cost of capital will be that percentage of 10% on your net assets. So if it's good for you to have your cost of capital, you can calculate it from a different place, or what you can do is you can put it here. So 10% for A, if you're doing 10%, 10 out of 100 times the net assets of A that they have given us is 135. 135. For B is 180. 10% times 180. Then for C, it is 150. Still 10%. Okay? Now, you get to realize here, if you calculate this, this will give you 13,500. Then this will give you 18,000. This will give you 15,000. As you can see from what the question has given us. Now, if back to our question, let's see what the question is saying. They're saying all division managers are unhappy with the changes in the performance measurement and have suggested that senior management adopts the
Sasa, vai, aqui é uma sobre